Gautam Chachuria, head of India Small and Mid-Cap Research with UBS Securities, joins us live now. Gautam, good morning. Thank you for joining us. Gautam, almost 6,000 for the Nifty. Indian markets have recovered nearly 4.5% for the week gone by, and we have recovered more than 5% from the budget low. What is happening? What is going on? How much more do you think Indian markets will rally in the near term?
Good morning. I think it's back to basics post the initial disappointment after the budget. I think the market expectations were running too high on the budget, but I think the biggest takeaway from the budget is, I think, finally sinking in that this will help the fiscal consolidation. I think which is the most important ingredient needed for economic recovery ahead. So that is gradually being digested. I think speaking to investors also, they realize that the path which the government is taking is possibly the right path. Again, it's not going to be an obvious one-way recovery. There is a lot of difficulties ahead, but market is gradually digesting that. And again, even in the global macro side, you have seen things stabilizing over the last couple of weeks. So that's obviously helping the investor sentiment towards India. On the markets moving up from here, I think our risk-reward framework indicates that the markets can go up to 6,400 odd over next few months. So that's the kind of upside scenario for the market given the current earnings and valuation framework. While on the downside, we have been talking about 5,600, 5,650 levels. So it's somewhere in between those two numbers in terms of the market trading range. Beyond this trading range, for the markets to move up, will need more clearer signs of recovery in terms of growth finally coming back. So you will need to get clearer visibility from the corporate sector in terms of earnings bottoming out, in terms of them looking to start spending for growth again. So that's, I think, still some time away. That will take at least a quarter more possibly. But at these levels, it still looks attractive enough for the markets to go up further from here.
Gautam, hi, morning. The trading range that you just talked about, is that based on the assumption that the RBI would oblige with a rate cut, if not this month, perhaps the next?
No, our trading range is based on pure fundamentals in terms of earnings growth estimates, the fair valuation multiple for that, and the market typically trades plus minus one standard deviation around that trading range. So that's where the trading range comes in from. For the RBI, I think we have been expecting a rate easing cycle this year. But we not, again, just to put it in context, just like the economic recovery, it's not going to be a big bang economic easing cycle. Even on the economic recovery side, we're expecting a mild cyclical recovery. We're not talking about economy going back to 8% GDP growth rate. But where the economy is right now, you can expect a recovery. Same with the RBI monetary policy. You won't see the repeat of what you saw in 06-08 period where there's a massive easing cycle. But you will possibly see up to another 75 basis point of easing from here on. That is not really very big, given that the current interest rates are around 8% odd. But in the context of where we are in the cycle, that will definitely help sentiment as well as obviously corporate capex cycle to a small extent here on.
What are your thoughts on large cap IT stocks? You know, at a time when US economy is no longer contracting, it is expanding. Is it safe to assume that in the second half of this year, this calendar year, IT stocks or IT companies could surprise us on the upside with strong numbers?
Yes, that's definitely a possibility, and that's something which we have been pointing out when our IT analyst upgraded her view on the sector a few months back. And to us, that's a different possibility. It's already being seen in the commentary also from the management. Very early days yet, but you are seeing a bit of a cautious optimism in the management commentary outlook. And as we see that actually happening on the US economy side, especially with the hopefully at some stage the fiscal thing is behind us for the US, then obviously that will help in driving up the positive outlook for the sector. And to us, Infosys seems the best way to play it at this stage. But a broad-based stance on the IT services sector is definitely positive.
What about global cyclicals? Because I just noticed that you put a buy on Sterlite, Hindalco, Sesa. So are you structurally now bullish on metals, or are you only tactically bullish on metals?
No, this is clearly a tactical call. both on some sort of similar cyclical rebound we are seeing in the global economy, as well as the seasonal uptick which we see in China also around this period. And again, specifically in India's case, a lot of these stocks were quite beaten down. So from a positive market view outlook, these should benefit from that also, especially the steel space.
Gautam, what's the call at UBS on the slew of OFSs that we've seen? Did you participate in RCF, and are you looking to participate in the rest which are lined up? NALCO today, perhaps the floor price is going to be announced, and SAIL which is lined up next.
So no specific view on individual cases, but again, generally from a top-down perspective, this is clearly a positive for the macro. Again, in our view, these OFSs are not necessarily bad for sucking out liquidity, because the other way to look at it is that if these OFSs get priced in well and investors start making money on them over the next couple of quarters, then that creates a virtuous loop. And even if you look at historical data points as to amount of money raised through divestment or even capital raising, that's really not been associated with market returns being dampened historically also in India's case. So clearly that's not really a dampener in our view. And again, given India's broad macro cycle where corporates are restructuring, even the government sort of is restructuring its balance sheet by doing these divestments, clearly the success of these divestments and capital raising will be a positive for markets. It's a chicken and egg thing, but to us this represents one of possibly a positive catalyst for the market in the next couple of quarters.
Gautam, round 2 of the Spectrum auction is slated for today. What's the call on the likes of Bharti, etc., considering you guys have been bullish on that one forever?
So our call is that the business case for a new license is not there. And again, post this round of Spectrum auction being behind us, it will become a much more clearer field for the existing incumbents to demonstrate the pricing power which they potentially have. So that will be the next big catalyst for these stocks and for the sector. Again, on the regulatory side also, I think most of the hurdles are now getting behind us. So it should be positive times for the sector in the next 2 to 3 quarters.
Fundamentally, are you now bullish on DLF? It is at 279, up 22% for this year. They've sold some of the non-core assets. They're really trying hard to reduce their debt. Is it safe to assume that fundamentally speaking, DLF now has a bottom in place?
That has been a call for a long time, and it was one of the top picks for us in real estate space. We've just taken out real estate from a model portfolio, but in terms of the fundamentals, their strategy seems to be working out in terms of deleveraging and also focusing on new launches. I think DLF still looks well placed to benefit from its strategy. And again, from the macro point of view, if you see the macro turnaround happening, then clearly real estate will be an obvious beneficiary of that.
What about mid-cap real estate stocks? We've seen a virtual bloodbath in the likes of Anant Raj, DB Realty, HDIL. I mean, those stocks have got decimated.
Yeah, thankfully not in our coverage of stocks, we haven't seen that happening. But I think if you see the stocks getting impacted, typically where the pledging of shares has been high, those are the stocks which have been most impacted with concerns on margin calls, etc. Secondly, as we have seen over last year or so, the local inflows has been very, very big. In fact, local mutual fund insurance have been seeing outflows, and they are typically the first who support these mid caps. And the foreign investor inflows which we have been seeing has been largely directed towards the large cap names. So the liquidity support for the mid cap, small cap support stocks has been clearly lacking in this last 2, 3, 4 quarters, and that needs to change for the stocks to come back much more strongly. Until that happens, I think you will see these stocks continue to languish in this space, continue to languish in general.
Gautam, you track the mid-cap consumption theme pretty carefully. What's the call on names like a Titan, Jubilant FoodWorks, or for that matter, TTK, because they haven't had the best quarter in terms of earnings this time around?
So top down, we have been underweight consumption, including staples and discretionary and autos for last couple of quarters. and we've been highlighting that these sectors will face headwinds. And purely from a market's perspective, if you look at two scenarios, if you see a cyclical recovery in the economy, then investors who have been very overly invested in this space, they will possibly move out of the space towards more cyclical ideas. And if you do not see a recovery happening, then the headwinds which you have been seeing for last 2-3 quarters, they will lead to even more for further disappointment in numbers. And unlike a lot of other sectors, unlike infra or banks, etc., in the broad consumption space, the earnings estimates are not really conservative. They have been extrapolating the growth which you have seen for last couple of years, which is all-time high growth rates, and extrapolating high margins, and the stocks are trading at all-time high P multiples. So the risk reward clearly seems on the downside to us on a top-down perspective, and therefore we are underbid on this space. Specifically in the stocks, we have a neutral rating on TTK and Titan, and a sell rating on and Jubilant Foodworks, because next 6 to 12 months the risk reward doesn't seem attractive enough for these stocks yet.
What about pharmaceuticals though? Are you invested in those names, and is there any stock in particular that you would still recommend to your clients to go out there and buy?
So not really a high conviction sector at these levels. So we had been overweight on that space till a quarter back. At these levels, I think the risk reward is again turned against them in terms of the next 6 to 12 months return framework. So we are underweight pharmaceuticals at this stage. Again, the long-term story still remains intact, but from a risk reward framework, next 6 to 12 months will definitely be underweight on this sector.
Gautam, what are the kind of sound bites you're picking up from some of your institutional clients post-budget? Are they still inclined to buy India? Because the problem for India now is growth. The fact that we've got a GDP print of less than 5% for the quarter gone by, is that number making global investors nervous?
Yes and no, and that's why we published a note a couple of months back talking about you can't have the cake and eat it too. That basically when the markets have been demanding fiscal consolidation, you should not ignore the immediate short-term impact of any fiscal consolidation, which is weak economic activity in the near term. So I think that did result in some nervousness initially among investors, but gradually they're digesting that this is fiscal consolidation in play. And remember the fact that for these global investors, India is just one market. They have seen this fiscal consolidation play out in multiple countries, including what they have seen in Europe or even US to some extent. So they know the short-term impact of that fiscal consolidation. So they won't get overly worried about that as long as they continue to see a clear direction and focus from the government in terms of reviving the economy. So they would watch out for what the government does over the next couple of months in terms of reform measures, or even in terms of trying to expedite investment cycle recovery. So that will be far more critical in my view for the markets and for their sentiment rather than just the quarterly print of the GDP data.
Gautam, final question. Anything from the mid-cap stock which was not part of your portfolio, but you've added that off late after the price correction?
We've added Blue Star as one of our top picks in the mid-cap as well as India model portfolio because after the correction of the stock, it does look very attractive. We don't see any material downside from these levels, and even in a slight cyclical recovery in the economy will have a very big impact on earnings as well as stock price performance from here.